Are old companies worth taking a look at and investing in? I certainly believe so, especially for a value investor. Prudential is an example of a company that can really offer up a value investor a great proposition. It's up really nicely, up about 38% in 1 year. This is a company that is well known for their life insurance, but they also do financial services, providing retirement services, annuities, and a variety of other insurance products. It is a company that had a couple rough years, but more recently it's been doing really well. I'm glad I invested in the stock about a year ago, and it's really done well. I wanted to take a look at the company, look at their fundamentals, their financials, and value the company and see what I think the company is worth, and then make a decision to buy more shares, just hold my shares, or sell my shares in Prudential. This is a nice dividend payer. They pay over a 4% dividend. They also buy back shares. So, overall, a really good positive company. Now, before I jump into their fundamentals, let me remind you that I'm an individual value investor, just sharing my experience, my journey as an individual investor. I'm not recommending you buy Prudential, not recommending you sell it, and I'm not providing any financial advice. Now, let's take a look at Prudential. The company has a market cap of 42 billion, and a long time ago that was a big market cap. Nowadays, geez, that's a mid cap, which is incredible. Their revenue is above their market cap at $60 billion. Their forward PE is only 8.4. Wow, really low PE. Again, their dividend is 4%, which is really nice, 4.4%. Analysts have a hold rating, and they think the price of the stock is a little oversold and being sold at a premium of 9%. The stock's done really well. Year to date, it's up 14%. Over the course of the year, it's up about 49%. Looking at the 5 year, you can see where the stock had some trouble, especially getting out of COVID. There was a good buying opportunity, and it peaked at around $120 a share, and then it really came down last year, and it really provided a nice purchase price to a value investor. So another lesson where value investing, do your homework and wait for the price to hit a particular level that makes it a really good investment. So it provided a good buying opportunity not too long ago. Looking at the income statement, Prudential's revenue has been a little sporadic. They've had growth and then contractions. In 2020, the year of COVID, understandably, their revenue went down, but then it really bounced back the following year, 24% growth in 2021. But then it came back down in 22 and down again in 23. So it'll be important for them to begin to grow. Their balance sheet is in very good health. They carry a fair amount of cash and they have some debt, but not too much. Overall, this is a financial services insurance company. So they get to hold a lot of their customers' assets and invest those and make money off of them. Their cash flow is really positive. It's for 2023, they generated $6.5 billion and they really don't have any CapEx. Their current run rate, which I'll look at as part of their earnings, is even better than 6.5 billion. So I'll use those numbers in my valuation that I use free cash flows on. Earnings per share look good. This year, it's expected they're going to do $13.66, and they're going to grow in the future. 2025 earnings per share are going to grow 7.5, and then in 26 they're going to grow 7%. So earnings per share is looking pretty healthy for Prudential. Prudential announced earnings on April 30th, and the market really liked what they saw. The stock is up more than 6% since the earnings report. And looking at their earnings, their revenue did go up, which is really good to see. Net income was up, which is good. Revenue was up. The capital return to shareholders, both in the form of dividends and stock repurchases, were higher. So it was a really positive report. And it's showing that Prudential is on a course to grow revenues, which is really important. I think if they start growing revenues, the stock's going to continue to rally. If they contract, the opposite's going to happen. I think investors will be really concerned that the company is not going to grow and is probably going to go away at some point. I wanted to calculate the value of Prudential that I believe the company is worth using free cash flows and earnings per share. I'm going to start with free cash flows, and I'm going to start with my forecast with last year's free cash flows, which was 6.5 billion, and grow those cash flows very conservatively by 2%. All cash flows beyond year 4, I'm going to grow by 3%. I'm going to discount those free cash flows to assess the net present value of those cash flows by 10%. That's a higher than typical rate, and that's because Prudential's revenue has been sporadic. They've grown and contracted, and that makes me more nervous. So I want a higher rate of return. By taking the net present value of all the cash flows, I get 84.3 billion. Adding the cash on the balance sheet and taking away debt, I get to an equity value of $83 billion. The market cap's only 42 billion. So it's a really big discount if you look at the cash flows that this company produces. The earnings per share are real positive, 13.66 for the current year. And I'm going to have a PE of 12. It's now a growing company, so I'm willing to give them a 12 and really not grow the earnings per share. I'll be really conservative. Even with that conservative growth rate, the value of the stock using earnings per share is $163 per share. The shares are being sold for 117. So there's a nice 39% discount if you look at earnings per share. Blending the two, I get a 77% discount, which is a really high discount on Prudential. The Prudential balance sheet's in very good health. The net debt for the company is only $1.2 billion when you take the debt minus cash. And the EBITDA for the company is almost $3 billion. So it's about a 0.4 ratio debt to EBITDA. And I'm looking for less than 3. So it's well beneath that 3. Looking at the income of this particular stock, it does really well for me. It produces about $715 of dividends per year. That's about $60 per month on my investment. The value of my investment is $16,000, and I paid $12,600 for the investment. So I have a nice appreciation of 33% on the stock. So it's been a winner that pays income. So overall, a nice investment in Prudential. So should I buy more shares of Prudential, hold, or sell? Well, let me look at the 3 areas that I like to look at before I make that decision. First is the company. Do I like the company? Do I believe in them? And do I like their management team? So overall, I do like financial services. I think that it's a very lucrative, profitable, high cash flow generating industry. So I like that about them. I do like Prudential. They have a very good brand, and they have businesses that they really have done for a long time and have done well. The one thing about the company is they're kind of a turnaround story. They had to come back from some bad years, and I think they're doing a good job. It's a rebound story, and I do believe in the rebound they're having. The management team's doing a good job in navigating them to more prosperous years ahead. The balance sheet. The balance sheet's in really good health for Prudential. Kudos to them for managing their balance sheet well. The discount. This is a highly discounted stock, which is really interesting. Yet it's kind of a neglected stock. It's one of those boring stocks. It doesn't get a lot of attention, and that's interesting. What am I going to do with the stock? I'm going to buy more shares of Prudential, especially on down days. I really like their dividend, and I really like their appreciation. It's been a good stock for me. Hey, thank you for watching the video. I hope you found it interesting. Good luck investing in 2024.